So we have a fairly disciplined way of looking at positions. Everyone on my team has some kind of engineering or scientific background, and we believe in systematizing a process for analyzing our stocks. And we have a big matrix where we have a bunch of criteria that we're looking for. A lot of them are qualitative things where we're making judgments. It might be quality of management, or it could be the quality of the company's products or services, or it could be how innovative the company is. It's a bunch of things that require years of experience to judge, but we're scoring all of these things out that a lot of asset management shops I don't really think, frankly, systematize and score. I mean, they're probably good at valuation and the quantitative aspects, but they're not really systematizing the qualitative aspects of investing. We've got a whole matrix where we're scoring every position across a bunch of criteria. We're force ranking everything that we own. We're force ranking that versus all the things we've done research on that we don't own, looking for logical swaps to upgrade our portfolio. So we're looking for to get the most weight in our position sizes behind our highest conviction ideas, the ones that have the most upside, but also have the best spectrum of qualitative features going for them. So obviously the higher it scores, the more weight we want to have behind it. So that's one dimension. The other dimension, though, is risk, is what can go wrong, what's the volatility of outcomes, the variance of outcomes that can happen in a company. In some types of businesses or investments, you have a more narrow range of outcomes that can happen. There's just only so much that can go wrong operationally, financially, in the marketplace. And you have others where there's a much wider spectrum of outcomes that can occur. It could be a business that's got a lot of cyclicality to it. It could be a commodity-sensitive business. It could be a business sensitive to macro factors. It could be a business where demand fluctuates a lot. You've got to take all of those variability factors into account along with the attractiveness factors and kind of put those together in terms of deciding weights. And so we have our own method of upsizing positions where we've got that intersection of super attractive thesis, high upside, lots of great qualitative features, great management team, great set of catalysts ahead of it, but also low variability of outcome. Those are going to be our highest positions where we get the intersection of those two things, certainty and attractiveness. And then the position sizes will get smaller the more speculative the outcomes are. So often we'll have ideas where it might be, say, a leveraged company that's going through a turnaround. The stock's heavily depressed, maybe it's down 80%, 90%, but there is an interesting prospect for a turnaround. Maybe it's a new management team, maybe the company's selling some assets to delever the balance sheet. Could be tremendous upside in these situations, but still a lot of uncertainty as to whether they can actually achieve it, whether they have enough time to get through the tough period. So those might be very small positions. They might be 1% positions or 2% positions, but they have a lot of potential upside in them. Whereas the ones at the top of our position sizing rank may not have the same upside, but they have a lot more certainty around them.